Good morning. With Eurovision viewers providing their sense of what's really going on in the world, it's time to take a look at finances. US indices were back in dark mode yesterday, the Dow leading the pack with a 0.8% drop. I'm doubting this is all because Congress just approved legislation to codify the ban on insider trading. While it's against the law, apparently this hasn't actually been formally written down. Fitch believes the index rumble is due to electronic chip shortages, which by now have cost car manufacturers, for example, a whopping 5% of annual sales. The dollar is marginally up after the Red Book lost a percent to 12.6 year on year, and building permits and starts failed to meet expectations. Increasing lumber prices are said to be the main problem, but Reuters also reports an acute shortage of previously owned homes for sale. Except the DAX, CAC, and Euro stocks, Europeans' equities sang yesterday, marginally green except in Sweden, which managed to actually gain 0.9%. Unemployment fell somewhat in Q1 as the union delivers its preliminary GDP reading for that quarter, a 1.8% contraction in line with expectations, and a trade surplus that fell by 8 billion euros in March to 15.8 billion. We're seeing some positive sentiment on both the euro and pound this morning after car registration in France increased by 570% year on year in April, easily overshadowing Germany's 90% rise. In the UK, that figure is a staggering 3,000%. It's a ludicrous increase in new cars just because we can now drive them unmasked. Consumer inflation in the UK has doubled to 1.5%, and all PPIs also exceeded expectations quite nicely. Sentiment is down on the DAX at the moment. We're at the top of the range. Futures are negative. The RSI is neutral with a tinge to bearish, and we're getting awfully close to the moving average, an asset that ended yesterday in a fearful shooting star. On the FTSE, on the other hand, we can be a bit more optimistic. We're vastly oversold, well below our moving average, and that 69.85 support level seems to have held last night. There's not a lot of data to go on ahead today, except EU CPIs in about 2 hours, so it's up to the shares themselves as earnings dawdle on. Asia is mixed again today, the Shenzhen up nearly 0.5% and the Shanghai down about the same, all on inflation worries, energy stocks and banks. Hong Kong was up 1.60% and the Nikkei down 182. The yen fell alongside it, oblivious to this morning's 1.7% increase in March's industrial production. Meanwhile, the Yuan continues down somewhat on a risk aversion, and despite central bank moves to move it higher. Add to that U.S. naval muscle near Taiwan and a call to ban the Beijing Winter Olympics, and, well, bankers are not happy. On the other hand, Joe Biden has delayed the ban on Chinese equities delisting from U.S. exchanges by 2 weeks. The new deadline is June 11th's opening bell. The ban originally put in by Trump targets U.S.-listed Chinese companies with ties to the nation's military. Iran and the U.S. are reportedly making progress towards a deal limiting the former's nuclear ambitions in return for putting their oil back online. The EIA yesterday published a warning that companies should stop funding new oil, gas, and coal production if there's any hope of reaching zero emissions by 2050. And oil itself is nearing the bottom of its 2-week range after the API reported a better-than-expected 620K build. Gold has slipped into a side range as well after Bitcoin yesterday plunged to well below the 40K mark. That places it officially within the confines of a bear market. I'm sorry that slide says WTI. We are looking at gold. It's lost 33% of its value in all of 9 days. Not helping is a new ban by the Chinese government on financial institutions providing crypto transaction services. We can quite easily see how things can go either way for gold. Again, please don't pay any attention to the WTI in the upper left-hand corner. That is a mistake. We're slightly overbought on the RSI, but the MACD is heading for a cross above its signal. On the other hand, we have quite a bit of negative sentiment behind us on the volume scale. One thing to do is stand by for mortgage and retail data from the US later this morning. Plus, crude inventories at 2:30 GMT. Did I tell you that that's the gold chart, not WTI? Then there's the 20-year auction at 5. And the Fed minutes an hour later. Macy's soared past expectations. I have to stop giggling. In its Q1 report yesterday, announcing a 56% increase in sales to $4.7 billion and a 32-cent EPS. That's compared to last year's $11 loss. Home Depot also did well with a 33% increase in revenues to $37.5 billion and a 95% increase in earnings. That's to $3.86 per share. And Walmart also passed expectations. I am so glad I am not reporting on the situation in the Middle East at the moment. Walmart passed expectations less dramatically with a mere 3% increase in revenues to $138 billion. It's hard being big. Stellantis, that's Fiat, Chrysler, and Peugeot to you, is reportedly joining up with Foxconn to develop car use technologies. And Facebook continues its drive into financial services. It's now introducing live shopping, which enables users to interact with vendors in real time. Concentrate, this is live television. And Amazon is facing an antitrust probe in Germany. Today, Cisco takes to the quarterly's podium while Lowey's and Target represent the retail side of things. The problem is high expectations overblowing retail stocks based on yesterday's result for Macy's and Depot. On the other hand, I am so sorry. Target's outperformed the S&P quite consistently thanks to a well-developed online presence and same-day deliveries during the pandemic. Meanwhile, soccer lovers will be awaiting Juventus results on the London Stock Exchange. Play on.